First, my partner, Chris Williams, who is also a member of our firm's Municipal and Land Use Planning and Expropriation Law Group. Chris practices in all areas of municipal law, including land use planning and development, expropriations, environmental law, administrative law and litigation, development charges, educational development charges, user fees and charges, sign regulation, conflicts of interest, municipal restructuring, building code matters, and there's a long list. He regularly appears before municipal councils and committees, the Local Planning Appeal Tribunal, formerly the Ontario Municipal Board, the Board of Negotiation, the Assessment Review Board, and all levels of courts in Ontario. Chris has appeared before the Federal Court of Appeal, and the Supreme Court of Canada. I'm also joined by two chartered accountants and chartered business valuators, Mr. Paul Colangelo and Mr. Glenn Toutrams. Paul and Glenn have had occasion before to be on opposite sides of expropriation matters, and I have them actually sitting on opposite sides of the table today, and together have many decades of experience in the business valuation field. By way of slightly more fulsome introduction, Paul Colangelo is a chartered accountant and chartered business valuator. He's a principal and founding partner of Colangelo Greenhow Inc., a broad-based litigation support and valuation practice. Paul has provided a wide variety of litigation-related support services since 1984. On a number of occasions, he has provided expert testimony in various legal proceedings, including before the Ontario Municipal Board. His primary expropriation experience has been with quantifying economic damages for claimants, including, just to name a few examples, a large Canadian automotive retailer, a large sporting goods store, a fitness health club, grocery stores, and other businesses. Glenn Toutrams is a chartered accountant and chartered business valuator. He's a principal and founding partner of Hallinan and Toutrams and has been providing litigation support services, including damage quantification valuations and forensic investigations for 25 years. His practice is focused on expropriations, and he's been involved with the majority of the larger construction projects in Ontario, including subways, road and highway widenings, extensions, and light rapid transit development. Glenn has provided expert testimony in valuation and accounting matters in front of the Ontario Superior Courts and the Local Planning Appeal Tribunal, formerly the OMB, in addition to participating in boards of negotiations and mediations. Glenn has given numerous presentations and papers to the legal and municipal communities on expropriation and business loss matters. He's also the Treasurer, Director, and past President of the Ontario Expropriation Association. So with those introductions, let's move into the content of our seminar. In terms of an agenda, we'll cover a general overview of business loss and business valuators. We'll review the statutory framework for business loss compensation, discuss how business loss is determined and how goodwill is determined. We'll discuss what is the role of a business valuator, evidentiary issues, and special issues in the establishment and quantification of business loss. And at the end, we'll have time for a question and answer period. By way of overview, and before I pass the mic to Chris to explain the statutory and legal framework for business loss compensation, just a few comments to set the stage. As you know, expropriations involve more than simply the taking of land and the establishment of its value. Expropriations and claims under the Act include the effect of the taking of land and the effect of the project for which the taking was sought on the use and the users of the land. From a business loss perspective, one might ask how the following situations might be compensated under the Act. First, a large retail store whose sales declined by 40% during the 5 years of construction of an adjacent subway. Second, a service center goes out of business when the highway it is located on is rerouted. Third, an industrial manufacturing operation that must move due to the acquisition of its landlord's property incurs increased production costs, high moving and relocation costs, and temporary loss of productivity. And finally, a developer's luxury condominium project is delayed such that the market is missed and the project has to be scaled back due to a sudden freeze on development occasioned by uncertainty over a proposed expropriation of the developer's lands. All of these examples could be considered business losses, and in many cases, the business loss can far exceed the market value compensation for land taken. While appraisers and sometimes others such as planners, engineers, environmental consultants are often the first people that come to mind in expropriation proceedings because of their role in the establishment of market value of the lands or diminution in value for injurious affection, from a claimant's perspective, business valuators are who you may turn to establish whether there was a business loss and the quantum of those damages. From an expropriating authority's perspective, a business valuator can assist in helping an authority avoid business loss claims, helping to ensure that such claims are legitimate, and assisting in establishing the proper quantification of such claims. So with that overview, I'll turn it over to Chris to provide a brief review of the somewhat complex legal framework regarding business loss as set out in the Expropriations Act.
Thanks very much, Andrea, and thanks for the introduction. As you can tell, I'll do almost anything and have done almost everything. But one thing that I find particularly confusing is the concept of business loss. And my introduction to business loss in the context of an expropriation also involved my introduction to Paul and Glenn. And that, as I recall, was the National Sports Store on Shepherd Avenue, which suffered, at least Paul and I would allege it suffered, some losses in sales as a result of the construction of the Shepherd subway. But as I say, that was my glorious introduction to business loss, and to the two gentlemen who are with us today. I found business loss confusing then, and I have to say I haven't gotten too much less confused, although I don't want to admit that. The statutory framework for the claiming of business loss is somewhat complex and opaque. The Expropriations Act refers to business loss or business damage in a number of places in the legislation. However, it's not defined. So what we're left with is either an industry definition of business loss or a common law definition of business loss. And that's unlike some other aspects of damages that you can claim under the Expropriations Act, such as market value, which is quite prescribed and provides a lot of guidance for the appraisers. So what we're left with is a common law or industry definition of business loss, which widens the ambit of things that you can claim. Now, I'm not entirely sure if the framers of the Expropriations Act thought it was going to come down that way. But before I get into that, in a very general sense, business loss is a loss of net profit suffered by a business operating on lands subject to an expropriation. An expropriation could be of all the lands or just parts of the lands, or eligible for a claim for injurious affection under the Expropriations Act, even if there is no taking of lands. We'll come to a case that deals with that. Now, if you were approached by somebody that said, gee, I think I've suffered a business loss, and you thought, gee, that's interesting, where do I look to see what we do? You'd pick up the Expropriations Act and look at the index, and lo and behold, you'd be referred to Section 19 of the Expropriations Act. You might think, aha, here we are, and you open it up, and 19 looks like it provides a complete code for business loss. But once you read that complete code, you would be disappointed. The reason being, and I'll read this over for you, hopefully nobody falls asleep. Section 19 reads, where a business is located on the lands expropriated, so no injurious affection, it's got to be on the lands expropriated, the expropriating authority shall pay compensation for business loss resulting from the relocation of the business made necessary by the expropriation. And unless the owner and the expropriating authority otherwise agree, the business losses shall not be determined until the business has moved and been in operation for 6 months or until a 3-year period has elapsed, whichever occurs first. So you've got to be actually in operation, and you have to move the business. You have to leave the lands. And obviously that's not always or often the case. Obviously, if there's just a partial taking of the lands, the business may continue there. That's part number one. Part number two, and they're mutually exclusive, says the tribunal may, in determining compensation on the application of the expropriating authority or an owner. That's kind of a bizarre sentence because I don't see other places in the Expropriations Act where it suggests that the expropriating authority actually applies to LPAT to determine the compensation. And sorry, for those friends of ours that have joined from out of province, LPAT is the entity that has replaced the Ontario Municipal Board, and it's an administrative tribunal that deals with a large number of municipal land use planning and expropriation matters here in Ontario. So the tribunal then, even on the application of the expropriating authority, can determine an amount not exceeding the value of the goodwill if the business does not relocate. So that's a very restrictive section dealing with business loss, raises a lot of questions. What if a business just goes out of business on the site? You wouldn't think there'd be a lot of goodwill left if the business goes out of business. And goodwill, of course, is not defined. So we're left with a very narrow, prescriptive section dealing with business loss, which would leave out a whole lot of situations where a tenant or an owner of land loses a whole lot of money as a result of the taking, and often it's a situation where it's the construction of the project. For example, if somebody has a retail store next to a major arterial road, they're doing good business, and then the expropriating authority decides to reconstruct the road or build a subway and closes it for 3 or 4 years, there's going to be a loss. But that loss wouldn't come within Section 19, which seems somewhat unfair. So you'd look at Section 19, you'd talk to your client wouldn't be too happy because it looks like they may not have much opportunity to claim for a very substantive loss. So you go back into the Expropriations Act and you find Section 13, which is the basic damages section, and you read that over, and if you've looked at some of the case law, you might think, is this a damage attributable to disturbance, or is it an injurious affection? And fortunately, the courts have taken a rather benevolent and broad interpretation of disturbance damage in order to cover off the very narrow ambit of business loss allowed by Section 19. And the courts get a little bit of guidance from the Act where business loss or business damages are referred to rather obtusely in the Act in a couple of places. So if you went to Section 18, there's a definition of disturbance damage, and it provides that the expropriating authority shall pay to an owner other than a tenant in respect of disturbance such reasonable costs as are the natural and reasonable consequences of the expropriation, including where the premises taken do not include the owner's residence, which they wouldn't for a business, the owner's cost of finding premises to replace those expropriated. And you go down, the expropriating authority shall pay to a tenant occupying expropriated lands in respect of disturbance, so much of the cost referred to in subsection 1 as is appropriate, having regard to, and if you go down to D, in the case of a business, the nature of the business. So by implication, the framers of the Expropriations Act seem to have thought that business loss might be included in disturbance damage, which is a good thing that they provided that hint, although it's unfortunate that things weren't made a little more explicit. And if you go a little further into the Expropriations Act, because maybe your client's lands weren't entirely expropriated and there's an effect on their remaining lands, or maybe there was no expropriation at all, but there would be a situation where an authority had carried out works that adversely affects your client, you'd find Section 21, injurious affection. That says a statutory authority shall compensate the owner of land for loss or damage caused by injurious affection Now again, that's a rather short section, so you have to go back up to the definition in section 1, sub 1, to see what the heck does injurious affection mean. And fortunately, this was defined. You go down to A2, it says such personal and business damages. Now, again, undefined, rather, I think, poor draftsmanship that now they're using business damages as opposed to business loss. But I think they mean about the same thing. Resulting from the construction or use or both of the works as the statutory authority would be liable for it if the construction or use were not under the authority of a statute. And if you go a little further, you come to B, which is a situation where there is no taking of land. You can still get a business damage if you, as the business operator, suffered a loss, but only for the construction as opposed to the use of the project for which the expropriating authority, or sorry, which the statutory authority was doing the work. And we'll come to an example of that in a minute. So many, if not most, business loss claims are not pursuant to Section 19 of the Expropriations Act. For obvious reasons, as we've discussed, it contemplates a business in operation at the time of expropriation actually having to move as a consequence of the expropriation, or if it's not feasible, getting compensation that shall not exceed the value of goodwill, whatever the heck that is. Now, the Act, fortunately, as interpreted by the courts, includes many more opportunities. So business loss as a disturbance damage crept in fairly early on in the life of the current Expropriations Act. There's a 1974 decision of the Land Compensation Board, and that was a tribunal that exclusively dealt with land compensation claims pursuant to the Expropriations Act in Ontario. That tribunal was rolled into the OMB in around 1980 or 79. But some of these older decisions, you will see the citation as Land Compensation Board. This is a case called Blatchford Feeds Limited versus Toronto. In this case, Blatchford Feeds had suffered clearly a loss as a result of a project flowing from an expropriation of parts of its lands. And the Land Compensation Board struggled to find some way to compensate Blatchford Feeds. They looked at the Act, as we may have, and started with Sections 19 and 19.2. Clearly, Blatchford Feed did not fall within them. The board says the only section specifically dealing with compensation for business loss is 19.1, yet for Blatchford to come within 19.1, it was necessary for Blatchford to satisfy the board that there had in fact been a relocation of the business. And clearly that wasn't the case. The board then goes on and says the board is, however, not satisfied that the two alternative and mutually exclusive bases for entitlement to damages where a business has been disturbed is 19.1 and 19.2 are the only bases for such entitlement. The Act clearly intends to provide a statutory code of full and fair compensation for lands expropriated or injuriously affected. And then the board goes back to disturbance damage in 13.2b, looks at 18 as kind of a hint that business loss are included there, and ultimately, if we flip the overhead, the board comes to the correct determination. In the opinion of the board, the Act is intended to provide a full and fair compensation for all aspects of disturbance damage, provided it is not too remote, is the natural consequences of the expropriation, and then goes on in the final paragraph to explain how that fills in the obvious gap in business loss compensation in Section 19. Now that's a lowly decision, I shouldn't say that, of the Land Compensation Board. It was generally accepted and finally confirmed, generally for all time, by the Supreme Court of Canada in a often cited case called Dell Holdings versus Toronto Area Transit Operating Authority. And in this case, the Supreme Court of Canada awarded damages for loss of profits to a developer whose project was delayed due to uncertainty occasioned by a predecessor of Metrolinx, who were trying to build a GO station on the developer's lands. The predecessor to Metrolinx could not determine exactly where the station was going to go, told the city of Mississauga, we know, guys, you're right in the middle of the development approval process and you're near the end of it, but please hold off because we're going to put a big GO station here, but you know what, we haven't figured out exactly where to put it. So the developer's development was put on ice by the city of Mississauga. Several years went by, GO Transit decided where they're going to put the station. The developer finally got their planning approvals, was able to go ahead with the project, but aside from losing some land, also missed the market. And a question became, can you claim business loss for that? Can you claim for loss of profits? Clearly not in 1901 or 1902. However, the Supreme Court of Canada said this is a disturbance damage. The scheme of the Expropriations Act is to make someone whole who's been through an expropriation, and this is where we think the compensation comes from. So clear direction from the Supreme Court of Canada in this case. And it's important to note that the loss of profit for disturbance damage was only the losses that were occasioned leading up to the actual expropriation. They weren't prospective losses, and I'll come to that very briefly, and I hope I'm not going to talk too much longer. I've got a lot of ground to cover, so I'll try not to speak quickly, but cut out the chaff here. Flip to the next page. There's a lot of quotes from the Dell decision. Any of you who act for expropriating authority often get these thrown at you by claimants who are advancing esoteric and sometimes bizarre claims for damages. These are some of the chestnuts that are set out here. So the takeaway is clearly business loss, including loss of profit leading up to the expropriation, is covered as a disturbance damage. Now, question often comes up with how far can you go for loss of profits? A claimant may say, gee, I had this fabulous idea for my lands. I had this great development. These guys came along and expropriated me. They've stopped me from doing it. I was going to make millions and millions of dollars with what I was going to do. And I just know I was going to do that. These guys should owe me for the profits I'd be making for the next 200 years. And that is often something that you may hear from a claimant or a claimant client. However, the ability to claim prospective profits has been somewhat circumscribed or cut out by the Ontario Court of Appeal in 747926 Ontario versus Upper Grand District School Board. It found that prospective lost profits for a developer were not included in the ambit of disturbance damage or as injurious affection. And the court also cautioned against what they saw as double dipping, because prospective profits for them was something that, if they existed, would be rolled into the market value of the land expropriated based upon the highest and best use. So if somebody said, I'm going to build this great condo development here and make millions and millions of dollars, that would be reflected in the value of the land, and they would take that in as compensation from the expropriating authority. The court here also decided, again, interestingly enough, that disturbance damage does not attract interest under Section 33 of the Expropriations Act, which, as everybody knows, is a base 6%, which isn't a bad investment these days. If we go to the next case, that decision has been followed. Houlihan Glenn, you had indicated you thought you were involved in that case, and that case might be
I am,
appealed?
or I was, and I'm not sure the status of it now. I mean, the decision has been rendered, and I think the parties are considering what the next steps are, if any.
Right. Okay, that case anyway is an example of following the Court of Appeal decision that we've just looked at, not allowing prospective profits to be claimed. Another case that's interesting is the City of Toronto and Simone Group Properties Limited, a divisional court decision here in Ontario, where the City of Toronto, in relying on the numbered company Court of Appeal decision, tried to say, look, Court of Appeal has actually said you shouldn't be able to get lost profits as a business damage. The divisional court said the City of Toronto was wrong about that, and there's a very clear distinction between loss of profits pre and at the point of expropriation, which are clearly recoverable, and loss of profits after the expropriation, which do not appear to be recoverable, but would be rolled into the determination of market value. We'll flip ahead a little bit. Injurious affection. As we've seen from the definition, there's a reference to business damages. Quite clearly, a business loss, including loss of profits, can be obtained as injurious affection. Interesting and leading case in many ways is Antrim Truck Centres and Ministry of Transportation. Again, a Supreme Court of Canada decision where a truck or a service centre which suffered a huge business loss and went out of business and had to relocate, or actually I think it just went out of business, as a result of a highway being changed in location. The service center was on a busy highway, had lots of business. Ministry of Transportation moved the highway, no expropriation, but suddenly nobody was going to this place because nobody could get to it or wanted to get to it. And the Supreme Court of Canada said that they were allowed to claim a business loss for the closing of the, or sorry, for the loss of the business. And as with all injurious affection claims, all the requirements have to be made. Injurious affection does have some prerequisites, and that has to be carefully thought of. So I've probably gone a bit longer than I should have. I apologize, gentlemen. And I will get off the air, and we will hear in a practical sense how is business loss to be determined.
All right, thank you, Chris. The main component when we start taking a look at business losses is there a causal relationship between the expropriation or the construction or injurious affection and the business and its losses or alleged losses? Some of the considerations we look at were, one, how is the business performing or affected at all three stages? And by all three stages, I'm talking about pre, during, and post-construction or expropriation. Because what we see, if we go back and take a look at historical sales, in some instances, the business was on a decline and the construction had almost no impact on the business in creating business losses. That's not always the case, but that's why we look at the history to sort of get a sense of how the business was performing and then look at it going forward. Also, you want to consider the business competitors. If, for example, everyone is doing poorly in that industry, taking a look at CPI or other measures, that would be also an indication that the business should not be doing well, that perhaps it had something other than the construction as a factor. Again, taking a look at the economy and industry during the business loss period, both at the macro and the micro level. So we're taking a look at the industry and also within the business. So we might look at, for example, in that niche area, whatever the surrounding area. So if we're looking at Toronto, the GTA, or whether we should be looking at Ontario or Canada as a comparative. Other things very specific to various claims such as marinas, manufacturing, gas stations are environmental impacts. You can think of things like carbon tax or hazardous materials, restrictions on what can happen in the environment. So if, for example, if you're a marina and you're not permitted to dredge anymore because it'll cause silt contamination and things like that, that might also impact your marina. That has nothing to do with the construction of a bridge nearby. Other unusual changes in the neighborhood was a new competitor entered. So if we're talking a grocery store, did a new grocery store open up down the road? Or a convenience store, did something else open up? Or, for example, a gas station closed down nearby that had a convenience store. So all of those can have impacts on this. And lastly is, has there been any change in key employees? One of the cases that I did, Venmar Bakery, it was against the Region Appeal. We were acting on behalf of the Region Appeal, and we found out that the key baker left and started his own business literally up the road. So those obviously had an impact on the sales of the bakery.
So, Glenn, it sounds like there's a lot of detective work.
There is. So, we use, you go online, you take a look around. We go through everything, including Yelp reviews. So just make sure every stone is turned over to, if you're acting for the claimant or acting for the authority, you don't want surprises.
Yeah. Take a forensic approach to it.
Yes. And so, once you've done that and you're comfortable with what you've seen, then you can sort of take the next step and do the math to calculate a business loss. So by doing that, you take a look at the sales, and as I said before, we take a look at trends. How is it doing before? How's it doing during or after? Some experts tend to get very complicated and taking a very empirical approach, statistical approach. I caution experts that do that it is difficult to translate that and explain it, and you can get caught in the weeds because there always is something that you've missed or an interpretation that could go the other way. So once you've done that and established a trend or a timeline for the sales, then we take a look at the cost of goods sold, because claimants often get confused that they come to us and say, okay, I've lost $1 million in sales, so I'd like to be compensated for $1 million. Please put a report together to ask for that $1 million. It's not that simple. You're not compensated for your lost sales. You're compensated for your below the line. How much has the business truly lost? So one thing we'd have to subtract off are the cost of goods sold that attached to that sales. So that here I've highlighted gross margin equals sales minus cost of goods sold. That's just straight math. That's proven accountant principle. So that's a starting point. So we would be looking at the gross margin and then making adjustments. And as Paul and I know, we take a look at variable expenses to see if there's anything below the gross margin line that should be considered on the income statement. And are there any saved expenses? By saved, we take a look at variable and did a business spend less? So their sales are down, but for example, did they use less labor? That would be a saved expense, and it's a cost savings to the business. Lastly, the final thing is incremental expenses. These are costs that are increased as the result of the construction or expropriation. Examples of those might be cleaning or maintenance, etc., and they represent a real and valid cost to the business. So that needs to be considered by the authority, and it needs to be considered by the claimant as well. And quite honestly, the only way you can do that is interviewing the claimant or taking a close look at every line in the income statement. Again, as Paul mentioned, taking a forensic approach to this. So just at a very high level, this is a very simple example of how we put all those elements together. And we start off with lost sales, and let's say it's $1,000. We subtract off the cost of sales, which in most cases is all variable, of $300 to get to a lost gross margin of $700. Now, I say that it's mostly variable. You have to take a look and just ensure that it is variable, because I have seen claimants throw in fixed costs into cost of sales, which should not be deducted when we're looking at business losses. We want to separate out those fixed costs because those are costs that are borne regardless, and they're fixed overhead. So subtracting those would be to the detriment of the claimant. So we've got lost gross margin. We subtract off other direct variable costs that we've figured out from the income statement to come up with our lost contribution margin of $600. But we figured as well that there's some saved expenses that the business would have incurred had they been operating at full 100%. So they've saved $150. So that has to be considered. And we add back the incremental expenses such as cleaning that they might have incurred in addition to what they normally do to come out with a business loss of $525. It sounds simple. It does get very complicated very quickly.
It's not simple.
No, I said it sounds simple.
It seems complex because there's going to be disputes over the facts going into the formula. Yeah. And I assume there are going to be disputes over the formula as well.
Yeah, I would say that for 99% of the cases, the lost gross margin could be reached and agreed with all parties involved, right. Because it's pretty straightforward. You might have some differences on if they use a percentage as opposed to actual dollars. So right. There might be some movement there, but the other below-the-line items are all going to be discussed between the experts and the claimant and authority. So you are 100% correct, Chris. Okay. So that's basically business loss in a nutshell. The question is whether it's applicable to injurious affection or whether it's applicable to straight-out construction where there's land taken or partially taken, and that starts becoming a legal issue. But the purpose of us as experts, as business law experts, are to determine the numbers, and then the lawyers will settle it out with the LPAT.
Yeah, and I suppose because business loss or business damage isn't defined in the Act, then my understanding is you go back to industry understanding of what those terms mean, or common law, which is applicable to a whole lot of other claims and uses of business loss.
Yes, in a lot of cases, but again, it's not always clear-cut because no one presents an income statement exactly the same way. You right. don't classify expenses always the same, and sometimes, just depending on the size, if you've got a large international company, a lot of their expenses are fixed overhead, but if you've got a small business, a lot of those expenses are variable. So you've got to, consider the business and what's going on to, truly get to the bottom line.
I guess that's the situation, too. You could be dealing with a variety store that's run into problems, or you could be dealing with some huge manufacturer, yeah. All business loss, but vastly, vastly different.
Exactly. So, we've seen claims that come in the small, under $20,000 to, $5, $6, $7, $8 million. So, right. And each of those needs a different consideration.
The terms I've grown up with is knowledge of the business.
Yes.
What makes it ticks? What are the key variables in that business?
Right.
And you'll see typically that it's A times B, variable A times B is equal to C.
Right.
And once you have an understanding of the variables of that business, the nature of that business, it helps in doing what Glenn has been discussing.
Yep.
Right. Right.
Great. All right. So that's business loss. Why don't we move on to goodwill?
Yeah, that's something that's always kind of bothered me, where you go and limit the amount of a claim to the goodwill.
Well, I'm not going to say it's hocus pocus, but, there is an element of professional judgment to this.
As in all valuations.
As in all valuations. So
it's a bit of an art as well as a science.
It is.
Or witchcraft.
Witchcraft.
No witchcraft.
Yeah. No witchcraft, okay.
So starting off, the easiest way to think of goodwill is you drive to the value of the business. So what is the fair market value of the entire business? And then you subtract off the in-use value of the net tangible assets. And that mathematical formula drives to goodwill. That is what we consider to be goodwill for purposes of the Expropriations Act. But that does not limit the compensation to the claimant, because the claimant can put a claim in for the loss of its hard assets or its leasehold improvements as well, assuming that they were not able to liquidate it or reuse them somewhere else. So all those considerations have to be made. Normally, goodwill is only an issue if you are relocating, if you've been terminated or have been effectively terminated.
Right.
I don't know if you want to jump in on this, Chris, but effective termination really is you may have relocated, but you've moved outside of your market area. So, for example,
right.
if a restaurant that was at the corner of 1st and 2nd moves to the other end of the city, it may have lost its client base where it was a neighborhood type of restaurant. So even though it has relocated, it may be effectively terminated.
Right.
And so then you've got to take a look at, is there a goodwill calculation here, or is there a business loss calculation here?
Right.
Yeah.
Glenn, when you use the term in-use value of tangible assets, in-use value, you're referring to what?
I'm referring to the net tangible assets. In some cases,
Excluding redundant assets.
excluding redundant assets, because in some instances, the businesses are so large that, for example, they might have excessive cash on hand, or they may have excessive properties that they don't use that all sit on the balance sheet that we take a look at, because that's how we start off with valuing goodwill. And we want to separate those out because they're not part of the business. They're
right.
extraneous to the business. All right. So as I said before, goodwill is based on starting point of the fair market value of the business. So as Paul and I were talking about, there's different methodologies that you can use. You can use it based on either the cash flow that the business generates or the earnings that the business generates. And that's a judgment call from your expert as to which you should be using. It also is dependent on what information is available to make that determination. But you have to be consistent throughout. Ideally, depending on whether you use a cash flow or earnings, you should arrive at the same number.
Mm-hmm. Yes.
Because if you don't, then obviously that's an issue. So some things, we'd start off with the income statement, and then we make some adjustments. So these are what we call normalization adjustments, where we're trying to get to make sure that we've got the fair market value of the expenses that go through. And depending on the size of the business, the smaller the business, there tends to be more personal expenses or non-fair market value expenses that go through that. And there's nothing wrong with that, but we want to make sure we understand, for example, salaries. There may be, the owner may be paying themselves a salary below market value because that's all the business the business can support.
Or I guess if the business was employing family members or friends. And
so you take a look at management, you look at who the senior people are, look at owner, look at family members, because often we'll see family members that contribute to the business where, for example, if you're a small convenience store, they might be stocking shelves and taking deliveries or doing the books, and that's not reflected in the salaries at all. We take a look at intercompany transactions because those are notorious for not necessarily always being at fair market value because there may be some rationale for having it below fair market value. And then looking at non-reoccurring expenses and sales, repairs and maintenance, advertising, etc. on my list there. So those are the basic adjustments starting off with. The other thing I just want to, before I move on, is we want to make sure the rent is fair market value. Because in situations where there's an expropriation or business loss, owners may be the tenants as well. So there might be a relationship between the two. So we want to make sure that that rent that is reported on the income statement is at fair market value.
Right.
That's where we would require the assistance of an appraiser to help determine that. So once we make our adjustments, we come out to a net amount, and then that's multiplied by a capitalization multiple, which again is determined by a business valuator to arrive at the fair market value. And some considerations. If the fair market value that we calculate is not positive, then by definition, there can't be goodwill. Because if we take a look at the prior slide, we said the math is fair market value minus the tangible assets equal goodwill. So if the tangible assets have a value above $1 and the fair market value is 0, there is no goodwill.
Right.
No positive goodwill. It would only be negative goodwill, which is not compensable.
So the claimant could be giving money back to the expropriating authority then?
I haven't seen that ever happen, but then you would be looking at only compensation
Right.
for the value of assets. And then just the last point here is, as I said, fair market value needs to exceed the in-use or the net tangible assets. Otherwise, there's no goodwill. So if, for example, we determine the value, fair market value of the business is worth $1 and the net tangible assets are worth $1, by the math again, the goodwill would be 0. So, so there is a little bit of a threshold.
Glenn, from a practical perspective, how often do you see successful goodwill claims, and what's the dollar range in terms of value that you've seen?
Quite honestly, it depends on the business. So, I can see little tiny restaurants that are scraping by that there is no goodwill. I mean, they're paying themselves a salary. So that's a whole other aspect of legal law that's been set out in various cases, and it's subject to another discussion. But I would say that if it's a true expropriation, that 50%, maybe greater, would be goodwill. It just all depends. And it all depends as well whether the claimant has been reporting all of its income.
Right.
Is that a problem?
That is always a problem. And unfortunately, the authorities and the Act and experts cannot rely on unpublished sales because that would be considered to be illegal. So anyways, so that's goodwill in a nutshell. Next, as I was talking about before, the role of the business valuator. So we have the triumvirate here. We have legal counsel, business valuator, appraiser, and there is an overlap. The appraiser and the business valuator have to work together to report back to legal counsel, and that's legal counsel for either claimant or authority. The business valuator deals with the business financial issues. We make assumptions. We are independent. We have to be independent per the rules in Ontario. And the appraiser deals with the land value. He or she is independent as well, but they may take a look at rent. We've got to take a look to make sure that the appraisal, when it's done, there's a couple of considerations. One is was it done based on income, or was it done on a comparative approach? Because if it's not done on income, then we need to figure out what the rent might be. We also have to consider is what is the highest and best use of the land? Mm-hmm. If the highest and best use is of some other use than it's currently being done right now. So for example, if there is a laundromat on the property and the highest and best use is as a condo development that the appraiser has valued it at, then there is no business loss. There cannot be any business loss because the laundromat was going to be terminated,
right,
or shouldn't be there.
Right, and the business loss would not be the great profits that the developer's going to make from this wonderful condo project.
Exactly. So, anyway, so that's one issue. Just as another example that I haven't got here, but I'll just run through. If we have a commercial building, for example, that has a parking lot, and the road is widened with the entrance changed, and the parking lot is reconfigured, but there's no loss of parking spots. Is there a business loss? Mm-hmm. Right? What we've seen is that the landowner, the commercial building owner, will put forward a claim for loss of income, loss of rental income, but they'll also put forward a claim for loss of market value. You can't have both. So again, there's that interplay between business value and appraiser that you need to consider so there's no double counting. So next, we get back, we're moving on to the documents that should be gathered, the evidentiary issues for the business valuator. And I think we can move on to the next slide. Turn it over to you, Paul.
All the work that Glenn has been talking about, well, it's you have to collect sufficient, appropriate information and documents. It's absolutely critical. Sufficient means enough. Appropriate means the right amount. The financial and other information you're collecting would be based on it would be subject to the nature of the business and the claim itself. Of course, your business valuator can assist you on that. I put together a quick little checklist. It's non-exhaustive, but it would include things like expropriation documents, the history of the business, ownership details and history. I had to file a matter where the earnings of an antique store was declining prior to the expropriation. Well, it turned out that 3 years prior to the expropriation, the individual had bought the business from someone else, and she was simply not as good a business person. We got into financial statements. It's nice to get at least 5 years, depending on the nature of the business, maybe a little bit more. Income tax returns, personal, corporate, access to the books and records of the business, general ledger, sales journal, payroll journal, details of payments to remuneration to owners and non-arm's length parties, family members. We talked about that. That might be needed. You need that for adjusting your earnings. List of fixed assets, identifying, as Glenn mentioned, identifying unusual, non-recurring or discretionary revenues and expenses. Customer list of key employees, lease, contracts, business plan. Interview people that you have to interview. Market data, state of the economy, competition analysis. Collect those documents that you think you're going to need for your extra costs, relocation expenses, professional fees, etc. Other expert reports as necessary. Map of the site. You know, what's happening here? Part of the location of this Canadian retailer, the side entrances were taken away. What's the impact on that? You get to see it as an accountant. You go out there and you can see how it's impacted the access to the store by customers. Photos of the affected area. Contact information with the external accountant. So there's a list you can do.
It strikes me, Paul, that photos of the affected area, especially if you're dealing with an allegation that the construction of the project was negatively affecting the business, let's say it's a retail store or a restaurant, would be really crucial to show, look, this road was all hacked up for 3 years, and here's the proof.
Yes, and as a valuator in quantifying the damages, it's useful for me to get back to knowledge of the business, what's impacting this business, and if you can see, whether it's photos or at the site, that there's no traffic coming in on one side, you're going, okay, that sort of makes sense. I think I believe that there might be a loss of sales because of this.
Right. Now, I recall the three of us were involved recently, we won't say any names, in a matter where there was some uncertainty as to when a project started and stopped, and the authority didn't seem to have good records of it.
Well,
surprisingly.
It's, sometimes it comes down to the construction records and logs, and depending on the length of time, things do go missing or get missed. So, as an authority, you want to make sure you've got an accurate log as much as possible. But it's one of those things. Big organizations, sometimes it does get overlooked. Fortunately, Google does assist with some of these things as well if you don't have photos. So those things tend to pop out. One thing I'm just going to add to the documentation here is, from an authority's perspective, we don't necessarily, or the authority doesn't necessarily need to see the personal tax returns if we're talking about a corporate business. It's only where you get into a small proprietorship that you would want to see those personal tax returns for the most part, unless there's something that the authority should be aware of. And finally, fixed assets. If you sell the business or sell those assets, we want to see copies of the receipts or contract for those sale prices, because those would be adjusted on the final claim.
Then we move on to mitigation. The claimant has a duty to mitigate. Mitigate meaning to me reducing the losses and reducing the extra costs. The things that you may take into consideration to do that as a claimant would be, say, to advertise, I'm still in business, come and see us. Signage, maybe adjusting the production line, or labor costs. We have to cut back on staff because we're just not as busy as we used to be. And if any steps taken by the owner, so there's financial motivation to the claimant to mitigate, should be compensable as far as I understand.
Yeah, that makes sense. They are
Within limits.
Reasonable
Yes.
costs.
I mean, and it's a matter of law. The courts and the tribunals have been very clear that there is a positive duty to mitigate.
Yes, and the claimant should be encouraged to be proactive.
Yes, and, you know, for counsel that's on the line, I would recommend that you discuss that with your clients.
Okay.
That's what I've got for duty to mitigate.
So I'll quickly go over some of the things from the authority perspective to sort of minimize the impacts. Obviously, signage is a big one. Communication with the affected or potentially affected businesses and with the community also assists. And as Paul and I were talking back and forth, video pictures, there's, you know, new technology out there. Use it. It is helpful when you have to tell a story. You know, if you need to take a drone, which some authorities are doing, run up and down the street to give a true picture of what it is, because pictures by themselves can be shown in different lights. So
You just don't want to get too close to Iran.
And then, as Chris was saying, you want an accurate timeline as possible. And there are other things, web communication, those type of things that you can do as well. Making sure you've got proper staffing, signmen, you know, if you need police to assist, just to keep traffic moving as much as possible.
We have just a couple of minutes left, so Chris, and we've worked in some answers to questions as we've gone along. But Chris, maybe you could just speak quickly about some of the special issues in business laws before we finish.
Speak real quickly, yeah. There's a number of issues that obviously come up, and they've been alluded to and discussed by the other participants here. Can a loss of potential profit be claimed? Likely not. But maybe the door is not completely closed on that. Certainly for development, I think the potential profit is rolled into the market value compensation. What happens if the business shuts down, relocates, is sold, or goes bankrupt? How can claims be structured with respect to tax liability? Decisions seem to indicate that market value is seen as compensation and does not attract tax, at least not in the same way that a loss of profits attracts tax as simply income. What happens if the business loss exceeds the value of the goodwill? Our guests have talked about that. How do you claim if it's not feasible for a claimant to relocate the business? That's a tough one. And what about claiming interest on outstanding business loss, which the courts have said you can't do it under disturbance damage, but does that mean you try to fit it in, if possible, as an injurious affection or as a part of the market value? Those are some of the questions that come up, and if we had another hour, we could fully explore those.
So I think that takes us to the end. We have some closing thoughts on the slide, which we'll leave you with. But it should be clear that business valuators are an important part of the consultant team for both claimants and authorities. And unfortunately, we're out of time. But I do want to thank Paul, Glenn, and Chris very much for sharing their expertise and their practical insights. And also, thank you very much to our marketing department, Harpreet and Casey and Camille. And thank you to Richard for your technical support today.